Welcome to The Explainer. Today we're decoding what is arguably one of the most consequential earnings reports in the entire tech sector right now, TSMC's Q1 2026 results. Seriously, if you want to understand the physical, nuts and bolts reality of the AI boom, you have to look at the manufacturer actually building the hardware. We're going to explore some absolutely staggering numbers today, including a massive 40.6% year-over-year jump in revenue. But we're also going to unpack the very real, multi-billion-dollar costs required to keep this monopoly running.
But right off the bat, let me just set the ground rules for what we're doing here. This explainer is entirely my own independent research, compiled directly from primary sources. Now, because TSMC is a foreign private issuer, we're pulling from their specific SEC filings. That means we're looking at their 6Ks and 20Fs, not the standard 10Qs, 8Ks, DEF-14A proxy statements, or insider Form 4s that you typically see for a US-based company. So we are simply reading the data, mapping out the facts, and looking at analyst commentary. I am not telling you to buy, sell, or hold anything. This contains absolutely no investment or financial advice.
Okay, let's dive into this. Here is our roadmap for today. We'll start with 1. The Q1 2026 blowout. Then 2. AI drives the profit engine. Next is 3. The massive CapEx catch. And finally, 4. The Q2 outlook and future realities.
Section 1. The Q1 2026 blowout. Staggering numbers from the AI supercycle.
The numbers we're seeing right now just totally confirm that the AI infrastructure supercycle is translating directly to TSMC's bottom line, and at a speed almost no one modeled for. They didn't just beat analyst consensus, they completely shattered the ceiling of their own internal guidance. Revenue hit $35.90 billion, which is a 6.4% sequential increase. But honestly, the gross margin is what really stands out. It came in at 66.2%. That beats their guided ceiling by a full 120 basis points, mostly driven by incredibly high capacity utilization and rigorous cost controls. Oh, and operating margin, that landed at a wildly strong 58.1%.
But here is the number that should really make you pause. 50.5%. That is TSMC's net profit margin for the first quarter. Let that sink in for a second. For every single dollar of revenue TSMC brought in the door, they kept more than half of it as pure bottom-line net income. It's a completely absurd margin profile, and it drove their diluted earnings per share to NT $22.08 or US $3.49 per ADR unit, putting them roughly 5.7% ahead of the street consensus. So you have to ask, what exactly is fueling this blowout?
That brings us to Section 2. AI drives the profit engine. The shift to agentic AI and advanced nodes.
Looking under the hood, advanced technologies, which TSMC firmly defines as 7 nanometer and below, now account for an incredible 74% of total wafer revenue. The 3 nanometer and 5 nanometer nodes alone make up 61% of the entire pie. This is the absolute bleeding edge of silicon, the exact nodes required by top-tier customers like Apple, NVIDIA, and AMD to build the world's most advanced AI accelerators, data center GPUs, and custom ASICs.
Now, what's really interesting about this platform breakdown is high-performance computing, or HPC. It just leaped 20% sequentially in a single quarter. It now dominates 61% of TSMC's total revenue, which is up from roughly 44% just 4 quarters ago. Meanwhile, the smartphone segment actually fell 11% sequentially to 26%. IoT grew 12%, and automotive fell 7%. Though management did clarify that the auto decline is just a temporary digestion period, not some long-term structural flaw. But the big picture here, we are watching a massive, real-time structural shift toward AI infrastructure.
To really grasp why HPC is exploding like this, listen to this quote from CEO C.C. Wei. He explicitly noted that the shift from basic generative AI, simple query mode, to agentic AI, where AI operates in an autonomous command and action mode, is leading to another massive step up in token consumption. It's an incredibly hungry compute engine. And because of that, cloud service providers are flashing a very strong signal and positive outlook, heavily buying top-tier silicon to feed these agents.
Checking in on their future technology roadmap, volume production for the 2 nanometer node actually began in late 2025 with good yield, and it's ramping up nicely at both the Hsinchu and Kaohsiung facilities. Plus, management confirmed that upcoming N2P and A16 enhancements are going to make N2 a really large and long-lasting node. Crucially, CFO Wendell Huang noted that the 3 nanometer node is finally expected to cross the corporate gross margin average in the second half of 2026. Looking slightly further ahead to 2028, TSMC is targeting their A14 process. This is a second-generation nanosheet that brings a 10 to 15% speed improvement or 25 to 30% power reduction compared to N2, along with a 20% density gain. It's incredibly impressive engineering, but dominating physics isn't cheap.
Section 3. The massive CapEx catch. The multi-billion-dollar cost of maintaining a monopoly.
Maintaining a 90+% market share in advanced chips requires a mind-blowing amount of capital. For 2026, TSMC just raised its CapEx toward the absolute high end of its range, hitting up to $56 billion for a single year. To put that in perspective, they spent roughly $40 billion in 2025 and $30 billion in 2021. CFO Wendell Huang clearly stated that the next 3 years of CapEx will be significantly higher than the $101 billion they spent over the prior 3 years. This money is funding 3 massive new 3-nanometer fabs across Tainan, Arizona, and Japan. But there's a huge catch. Management warned that these overseas fabs introduce a multi-year structural drag, diluting gross margins by 2 to 3% initially and eventually widening to 3 to 4%. Now, the silver lining is that Arizona Fab 1 is already operating, and they're much more confident in closing that cost gap today than they were a year ago.
Because of these staggering costs, a really fierce debate has opened up among analysts. The bull case, which we see reflected in price targets like Goldman Sachs at NT$2330, JPMorgan at NT$2100, and Morgan Stanley at NT$2880, argues that dropping $56 billion on CapEx is the highest confidence demand signal TSMC could ever possibly send. Finance Feeds echoes this with a $590 bull target. On the flip side, the bear case worries that this spending severely compresses free cash flow, which already dipped from 369 billion NT in Q4 down to 348 billion NT this quarter. Bears are deeply concerned about this multi-year cash drain, the inescapable margin dilution from those overseas fabs, and of course, the perpetual geopolitical discount of the Taiwan Strait. This cautious view is why we see bear floors like Finance Feeds' $330 target.
Section 4. Q2 Outlook and Future Realities. What's next for TSMC's AI dominance?
So what's coming next? Guidance for Q2 2026 actually signals a significant acceleration from what was already a monster Q1. They're guiding for up to $40.2 billion in revenue. That implies roughly 10% quarter-over-quarter growth and a massive 32% growth year-over-year at the midpoint. Gross margins are expected to stay incredibly strong, up between 65.5% and 67.5%, with operating margins holding right up there too. Now, you might notice that roughly 20% tax rate and think it's a red flag. I want to explicitly point out that this tax spike is purely a statutory requirement in Taiwan regarding undistributed retained earnings accrual. It is definitely not a sign of underlying business trouble. Honestly, the real constraint on TSMC's business right now isn't a lack of demand. It's not even power availability. It's their own capacity. Chip supply is the primary bottleneck for the entire global AI industry right now. On the earnings call, CEO C.C. Wei was remarkably blunt, stating that despite aggressively pulling forward equipment deliveries, leading-edge capacity constraints will persist through at least 2027. They literally cannot build fabs fast enough to satisfy what the cloud providers are demanding.
Which leaves us with a pretty provocative final thought. TSMC is capturing the value of this AI supercycle faster and far more profitably than almost anyone else on the planet. But maintaining that technological dominance means walking an incredibly capital-intensive tightrope while carrying the immense gravity of global geopolitics on their shoulders. Yes, the numbers today are undeniably spectacular, but the billions required to secure their position tomorrow show just how unimaginably high the stakes have become. Thank you so much for joining me for this explainer. I really encourage you to dive into those primary SEC filings yourself to see the raw data powering this AI revolution. See you next time.